You've heard the warnings. I mean, they're not just background noise anymore, are they? They feel like they're everywhere.
Oh, absolutely. Front page news, viral clips. Everyone seems to be talking about a major financial crisis on the horizon.
Specifically that 2026, maybe 2027 window. And the language being used is pretty extreme.
It is. The refrain is that this won't be just another recession. They're talking about a structural collapse.
Worse than 1929, worse than 2008.
And that level of anxiety, it's rooted in some very real and I have to say very alarming data points.
Right.
People are looking at these just astronomical market valuations in certain sectors. They're looking at record-breaking debt levels, household, corporate.
And the big one, the U.S. sovereign debt that just seems to defy gravity.
Exactly. They see this whole thing as one giant precarious everything bubble.
But that's the real question, isn't it? How much of this is just the usual financial doomsaying we hear every few years? And how much of it is actually, baked into the architecture of the system?
That's the mission today, really.
So our mission today is twofold. First, we're going to analyze these popular claims about the fragility, the bubbles, the debt, and really benchmark them against past crises.
And second, and I think this is the most critical part, we need to take a journey deep into the plumbing of the system.
The sophisticated, high-stakes plumbing of the modern U.S. financial system.
The shadow banking apparatus.
Yeah.
Because that's the hidden structure. That's what determines how the next crisis could unfold.
And most importantly, who stands to lose the most?
We have material in front of us that points in two directions at once. On one hand, you have extreme asset concentration, alarming debt trends.
But on the other, you have a century of regulatory learning since the Great Depression. We're supposed to be safer now.
So we have to hold both of those ideas in our heads, that we are in some ways structurally safer, yet we're operating on historically high levels of institutional leverage.
Okay, let's unpack this.
Where do you want to start? The public fear.
Yeah, let's start there. When we look at the public pulse, investor forums, financial media, the anxiety does seem, elevated. Is 2026 really different, or are we just more plugged into a constant stream of worry?
I think the difference is the breadth of the perceived risk. It's the scope of it.
How so?
Well, in past cycles, the fear was often localized. You had the dot-com stocks in the late 90s, then you had housing in the mid-2000s.
Right, it was one sector that was seen as the problem.
Exactly. Now, the fear is of the everything bubble. Analysts look at the total non-financial debt in the U.S. economy.
Which is what, over $90 trillion now?
Exceeding $90 trillion. And they see a problem of scale that just dwarfs anything we've seen before.
So when you hear predictions that 2026 will be worse than 1929 or 2008, it's not just rhetoric. It's because the underlying debt base is just so much larger.
That's the argument. The raw numbers are bigger.
And all this anxiety, it gets amplified by this market timing dilemma, right? We see so many videos, articles basically screaming at people to pull all their money out now.
The crash is coming. Get out.
Right.
And that impulse is so understandable, but it's also financially very dangerous.
For the average person, you mean?
For anyone with a long time horizon, say 15 years or more, trying to time the market, jumping out right before the peak and then trying to jump back in at the bottom, it's practically impossible.
And statistically, it's just a bad bet.
Frankly, it's statistically silly, as one analysis put it. The gains you miss by sitting on the sidelines often far outweigh the losses you might avoid in a downturn.
Do you have an example of that?
Sure. Imagine if someone pulled their superannuation or their 401k out just 6 months ago because they were scared.
Okay.
They would have missed the S&P 500 being up, 35% in that incredibly short window? You just can't recover that kind of opportunity cost.
So you're caught in this trap. You feel this moral imperative to protect your capital from a potential 40% drop.
Of course.
Yeah.
It feels like the responsible thing to do.
But the historical data is just crystal clear that staying in the market, riding out the waves, delivers better returns over the long haul.
You basically have to swallow your fear of the short-term loss for the sake of that long-term stability. It's a very difficult thing for a human to do.
Let's talk about the source of that fear, though, the valuations.
Okay, the extreme valuations. This is where a lot of the current anxiety is focused, especially the concentration risk.
Driven by the AI and tech sector.
Right. We're looking at a handful, maybe 6 or 7 major technology companies driving almost all of the market's gains.
This sounds suspiciously like the late 90s all over again. Is this different?
It is, in a couple of crucial ways. First, the valuation metrics themselves are just eye-popping.
Let's get specific.
When we see the S&P 500 trading at a price-to-earnings ratio, a PE, that's hitting 28 times earnings, Well, that's approaching historical bubble territory.
It's not quite the dot-com peak, though.
No, not quite the PE of 44 we saw right before that bust. But within the tech sector itself, some of the PE ratios are soaring. They're making analysts' eyes water, as one source described it.
So the valuations are assuming a level of future growth that seems almost impossible.
It strains credulity, yes. But the second difference is maybe even more important, and it ties back to how the profits are being generated right now.
The idea of the great money go-round.
That's the one. The internal dynamic here is fascinating, and it's potentially very unstable.
What does that mean?
These highly valued tech companies aren't just selling their services out to the general public. A huge portion of their business is selling to each other.
Selling chips, AI services, data center access.
To each other. They're simultaneously each other's largest customers and biggest competitors. It creates this self-reinforcing circle of money,
So revenue growth in one company immediately shows up as a cost for another.
which then uses that product to generate revenue, which it sells back to the first company.
So the massive market caps aren't just based on genuine consumer demand. They're being inflated by this aggressive capital expenditure and speculative internal exchange within a very tight ecosystem.
Exactly. We saw this exact dynamic in the dot-com era. In the end, only one or two companies, like Amazon and eventually Google, they emerged as truly transformative,
They generated the necessary real-world revenue to justify their scale.
while the rest, as they say, crashed and burned.
So the core question for today's AI giants is whether they can generate, a massive, maybe $10 trillion revenue stream from outside that internal circle to justify these market caps.
Or are we just watching a speculative fervor where massive internal investment is just funding the spectacular future losses of most of the players?
Yeah, and on top of that, you have this very distinct risk of a trigger event, something highly localized, like the commercial real estate crisis everyone's talking about.
The CRE crisis is a perfect potential trigger.
If you have billions, maybe trillions of dollars in commercial mortgages that need refinancing at drastically higher interest rates,
Say from 3% to 7, 8, even 9%.
that's going to crush the regional banks that are holding all those assets on their books.
And that could easily be the shock that starts the whole systemic cascade. It's a very plausible catalyst.
So to really gauge how bad a modern collapse could be, we have to look back, right? We have to set a historical baseline. Let's talk about 1929.
Okay, the Great Depression. The single most critical thing to understand about 1929 was the lack of broad public exposure to the market.
It was a rich person's game.
That's a good way to put it. How small was it really? Well, John Kenneth Galbraith's analysis shows that only about 1.5 million people had any active association with the stock market.
And what was the U.S. population back then?
About 120 million, so we're talking about just 1 to 2% of the population. It was an elite hobby.
And even within that small group, how many were using leverage?
That's the key. Only about 600,000 of them were using margin or borrowed money for speculation. So when the market crashed, it was absolutely devastating for that small group.
But for the average person, the farmer, the factory worker,
The systemic risk to them was minimal, at least at first. The depression itself came later, from the economic contraction and the banking collapse, not from the market crash itself.
and this is where the analysis gets, for me, really unsettling. Because today, that scale is completely inverted.
Completely. Today, nearly 2/3 of all U.S. households own stocks in some capacity. 2/3.
And this isn't speculative gambling for them.
Not at all. This is their retirement planning. It's their 401k, their pension funds, their managed assets. The stock market has become the primary vehicle for middle-class wealth accumulation.
So if the market were to have an 86% crash, like what happened between 1929 and 1932, an absolute annihilation of capital.
The social consequences would be unthinkable.
Catastrophic.
It would be. And this is the critical modern stake. Because the market is so thoroughly woven into the social contract, the argument is that policymakers and the powerful elite are far less likely to allow a collapse of that magnitude.
It would be political suicide.
An 86% crash today wipes out generations of middle-class savings.
Yeah.
It leads to political anarchy. It would destabilize the entire country. So the very high societal exposure to the market today acts as this strange kind of involuntary stabilizer.
The argument then is that the government and the Fed have this implicit, almost existential mandate to intervene far earlier and far more aggressively than they ever did in the 1930s.
That is the implication of the public put on the system. The government has to be the backstop because the cost of not intervening is total societal breakdown.
Okay, so if the risk is worse because the debt is so massive, but the consequence of a total collapse is just too high to contemplate, what safety nets do we actually have? What have we built since 1929?
We have a whole regulatory scaffolding that simply did not exist back then. We are not operating in the financial Wild West anymore.
The reforms after the 1930s created these powerful institutional stabilizers.
Think of the Securities and Exchange Commission, the SEC. It was designed to enforce market transparency and prevent the kind of widespread fraud that was rampant in the 20s.
And for the average listener, maybe the most comforting piece of all this is FDIC insurance.
Exactly. Knowing your bank deposits are insured up to $250,000. That single thing stops bank runs on traditional commercial banks, which was the real engine of the 1930s depression.
We also have things like stock market circuit breakers.
Right, which halt trading automatically during rapid declines. They provide these crucial cooling off periods to stop panic from cascading.
We have clear margin requirements, unemployment insurance, Social Security.
All of these act as economic buffers for households during a recession. It's a completely different institutional landscape.
And the Fed itself is different. We know that leading up to 1929, John Kenneth Galbraith called the Federal Reserve Board a body of startling incompetence.
I love that quote. The Fed today is a fundamentally different animal. It's armed with 90 years of crisis management experience and a massive flexible balance sheet.
We saw that policy learning in action in 2008. They prevented the great financial crisis from spiraling into a true depression.
They did. And then again, the 2020 COVID shock was met with this unprecedented rapid intervention that stopped a solvency crisis from becoming a liquidity crisis.
So they've shown they can deploy these emergency funding mechanisms, these public liquidity puts, to stabilize the system when they have to.
But wait, that raises a huge question.
It's a moral hazard question.
Exactly. If we have all these stabilizers and the Fed has learned its lessons and everyone knows the government won't let the market crash 86% because the consequences are too great.
Aren't they just implicitly guaranteeing all the leveraged private risk? Aren't they encouraging even more reckless behavior?
That is the central philosophical problem of the entire modern financial system. And it serves as the perfect segue to our next part.
Because the stabilizers are robust for the part of the system we can all see.
The regulated banking sector, yes. But the problem is, the vast majority of modern leverage, the kind of leverage that fueled the panic that required the 2008 intervention, it's all operating outside that regulated structure.
It's operating in the financial system's back alley.
The shadow banking system.
So we've built this great regulated house on what looks like bedrock, but we might be ignoring this huge, unstable leverage foundation in the back alley. This brings us to the shadow banking system. It sounds so clandestine.
It does, but it's really just the core of wholesale finance.
So let's define it. What is the shadow banking system, the SBS?
The SBS is, simply put, the vast, interconnected, non-bank financial infrastructure.
So not your local savings and loan.
No, we're talking about asset managers, money market funds, hedge funds, investment banks, and crucially, they operate outside of that traditional regulated system.
Meaning they don't take insured deposits?
And they aren't subject to the same strict capital requirements as commercial banks.
Okay, so if they're not taking deposits from people like you and me, what is their core purpose? What do they do?
To understand this, we need to look at it through what economists like Zoltan Pozsar call the money view.
The money view, okay.
In this view, the SBS isn't primarily about making long-term loans like a regular bank. It's about providing working capital for asset managers.
How does it do that?
Through what's called repo-based money dealing. It's a bit of a throwback. In the 19th century, merchants used real bills, short-term credit based on trade goods, to fund their operations.
So it's short-term funding for real-world business.
Right. Today, the SBS uses repurchase agreements, or repo, to provide short-term secured leverage and liquidity to the massive institutional investment world.
So the SBS is basically this whole ecosystem of huge institutional cash pools and highly leveraged investors.
All existing around these central organizing entities. The dealer banks.
The dealers are the key.
They are the critical link. A traditional commercial bank performs what's called maturity transformation. They take your short-term deposit and make a long-term loan.
Okay.
Dealers, in contrast, they don't really do that. They primarily intermediate risks.
What kind of risks?
Credit risk, maturity risk, foreign exchange risk, liquidity risk.
Yeah.
They do it all through complex collateralized transactions. They're the brokers, the matchmakers.
It's a central nervous system of global wholesale funding.
That's a perfect way to describe it.
You mentioned that proximity to the government is what determines safety in this world. To really get how a shock could travel through this system, we need to understand this hierarchy of money claims.
This is a critical framework. You can categorize all money claims based on their perceived safety, and that safety is derived from their proximity to the government and the explicit guarantees or puts that back them.
So let's start at the top, the safest.
That's public money. This is the closest you can get to the sovereign. We're talking about reserves that banks hold at the central bank and U.S. Treasury bills.
They're direct obligations of the government.
Backed by its full taxing power and its ability to print the reserve currency. There's no credit risk. It's the ultimate safe asset.
Okay, level 2 down.
That would be insured money. This is a private-public hybrid. These are your traditional retail bank deposits.
They're a private claim, a liability of the commercial bank, but they're backed by the government.
Exactly. They're backed by the bank's private loans, but they're explicitly guaranteed by the government via FDIC insurance, that's the public credit put, and the bank's ability to borrow from the Fed's discount window, that's the public liquidity put.
Which is why they're safe for you, the average consumer.
Correct. Now we move into the wholesale institutional world. This is where it gets interesting.
Level 3, public shadow money.
Right. These are claims issued by dealers and large money funds, but they are backed exclusively by public assets.
Like treasuries or agency debt?
Yes. So think of T repos, which are treasury repos, or government-only money market funds.
So these instruments, they perform maturity transformation, taking very short-term cash and parking it against slightly longer-term government bonds, but there's no credit transformation risk.
Because the underlying collateral is guaranteed by the U.S. government. These are for safety-seeking institutions that are just too big for FDIC insurance, so they need the collateral to be perfect.
Which brings us to the bottom of the pyramid, the riskiest level.
Private shadow money. This is where the inherent systemic risk really concentrates. These are claims that are backed by private assets.
Corporate bonds, municipal debt, complex asset-backed securities.
P repos, which are private repos or prime money market funds. All of that falls in this category.
And this is the real danger zone because these institutions are conducting credit transformation. They're issuing very safe-sounding claims, like a money fund share, but they're backed by assets that carry significant credit risk.
That was the mechanism that broke in 2008.
Absolutely. When huge institutional cash pools are chasing just a tiny bit more yield, they shift their money from public shadow money to private shadow money.
And that slowly, quietly increases the systemic risk embedded in the whole system. The moment the market starts to suspect that the underlying private collateral is bad.
Those massive cash pools flee and you get an institutional run.
Precisely.
So if these 4 categories of money show us where the risk lies, the dealers show us how it moves. You said the dealers are the linchpin. Why is their role so unique?
The dealer's unique position is that they deal directly with what's called the buy side.
And the buy side is?
The buy side is basically every massive institutional investor. Pension funds, hedge funds, sovereign wealth funds. Dealers are the primary source of funding for the entire spectrum of levered investment strategies on the globe.
They handle the FIC business fixed income, currencies, and commodities. But you said earlier they're primarily intermediaries, not speculators.
They are. It's so important not to confuse the dealer with the gambler. The vast majority of dealer activity is done on a matched book basis.
Okay, what does that mean in simple terms?
Think of the dealer as a really sophisticated broker. Or maybe like a dating app for finance.
A dating app, I like that.
They match a cash provider, someone who has cash and is seeking safety and short-term liquidity, with a cash borrower, someone who needs cash and is seeking yield and leverage.
And they just intermediate the risk between those 2 large institutional entities.
Taking a tiny slice for themselves. Only a small, highly regulated portion of their balance sheet is actually dedicated to holding speculative inventory positions.
So they're not necessarily taking massive bets on asset prices themselves. They're facilitating the massive leveraged bets of others.
Correct. They facilitate the movement of collateral and cash. But because they are the nexus point, the central hub, if one side of the market seizes up,
the dealer is the point of failure where the institutional run begins.
It's the choke point.
So let's look at the 2 players being matched by this dealer dating app. On one side, we have cash portfolio managers, or cash PMs. Who are they and what's their one and only mandate?
Cash PMs are institutions like central bank reserve managers or massive corporate treasury departments. Think of a giant tech company holding billions and billions in cash reserves.
Or the liquidity pools managed by the world's largest asset manager.
Exactly. And their mandate is unwavering. Do not lose. That is it. They prioritize safety above absolutely everything else, including yield.
And since they manage hundreds of billions of dollars, they're way too large for FDIC insurance, which you said makes them safety poor.
They're forced into these secured wholesale markets. They crave high-quality collateral, like U.S. Treasuries, and they are very willing to lend cash short-term in exchange for holding that collateral.
Okay. On the complete opposite side, we have the risk portfolio managers, or risk PMs.
The hedge funds, the proprietary trading desks, the highly leveraged asset managers, their mandate is the exact opposite.
Beat the benchmark.
Beat the benchmark. And they achieve this goal almost entirely through the use of one thing, leverage.
They use borrowed cash for what? Three main things?
Three main ends, yes. First, funding levered fixed income positions. So, buying $100 million in bonds with only $5 million of your own equity.
Okay.
Second, shorting securities, which is betting on a price decline. And third, derivatives margining, which means posting collateral to back complex swaps and other contracts.
So let's stick with the analogy. If the dealer is the matchmaker, what are the cash PMs and risk PMs actually trading with each other?
Okay, think of it this way. The cash PMs are the lenders, rich in safety, but they refuse to lend unless it's secured. The risk PMs are the yield-hungry borrowers.
Right.
The dealer facilitates the transfer of cash, which becomes leverage from the cash PM to the risk PM.
And in exchange.
In exchange, the risk PM transfers safety in the form of high-quality collateral to the cash PM.
So the cash PM gets their short-term return and the secured safety they crave.
And the risk PM gets the cash to go and amplify their bets.
This collateralized system is why, as the sources point out, bond portfolios across the entire ecosystem just become more and more leveraged over time.
It's a self-feeding spiral of leverage, because the bonds themselves are being used as collateral to borrow more cash to go and buy more bonds.
The whole system hinges on one single mechanism, you said, the repo, or repurchase agreement. We should probably slow down and explain this transaction very clearly.
Yes, this is the absolute key to understanding the whole thing. A repo is more than just a secured loan.
So walk us through the mechanics of it. Let's say it's a transaction in 2 steps.
Okay. Let's imagine a highly leveraged hedge fund. A risk PM needs $100 million overnight to fund a trade. They go to a dealer.
Step 1.
Step 1. The dealer sells $100 million worth of U.S. Treasury bonds, that's the collateral, to a corporate cash PM. The cash PM then transfers $100 million in cash to the dealer.
Okay. Step 2.
Step 2. The dealer agrees, via a contract, to buy back that exact same collateral tomorrow morning for $100 million plus a tiny amount of interest, say $500.
So legally, it's a sale and then a repurchase, but economically, it's just a secured overnight loan.
Precisely. The collateral guarantees the transaction for the cash PM, making it ultra safe for them.
And the cash the dealer gets from the cash PM then flows to the risk PM.
In the form of borrowed cash or margin debt, which is what fuels their big fixed income positions. This is how billions, trillions sow across the system every single day, turning safety into leverage.
It sounds incredibly efficient.
It is.
But it also sounds deeply, deeply fragile. Where's the vulnerability in that chain?
It's all centered on the collateral and the dreaded margin call. In this highly leveraged system, if the value of the assets held by the risk PM suddenly drops,
Say, a sudden widening of corporate bond spreads, maybe triggered by that CRE crisis we talked about?
perfect example. The dealer suddenly fears the risk PM's collateral is no longer sufficient to back the loan. The dealer will then issue an immediate margin call.
Demanding the risk PM post more cash collateral right now.
Instantly.
Yeah.
And if the risk PM can't post that cash,
They are forced to liquidate their holdings. They have to sell their assets into a falling market.
and that is how the systemic cascade begins. The institutional investors, the cash PMs, they run on the dealers. They demand their collateral back, or they refuse to roll over the overnight funding.
And the dealers, now facing their own funding crisis, they turn around and run on the leveraged risk PMs.
By issuing massive margin calls and forcing fire sales of assets, this rapid forced liquidation is what drives asset prices down across the board.
And this was the exact pattern of the institutional run in 2007 and 2008.
The exact same playbook. And the ultimate consequence, as we'll get to, is this colossal transfer of wealth. Because even though the primary players are all institutions, it's the middle class's retirement funds that are ultimately at stake.
Okay, so this whole shadow banking system, it relies on one massive implicit assumption.
Yes, it does. That when the inevitable crisis hits, the sovereign, the U.S. government, and the Fed will be financially strong enough to step in and be the ultimate backstop.
The government's perceived financial strength is the ultimate public put on the entire leveraged system.
Absolutely. But if the risk of collapse is driven by debt and valuations, then the official debt metrics we're using have to be accurate, right?
And our sources suggest they are not.
They're not even close. This is, to me, maybe the most insidious finding in all our material. Analysis of medium-term public debt forecasts.
From places like the IMF, the Economist Intelligence Unit.
Right. Spanning 174 countries over 25 years. It shows that these official forecasts are systematically, predictably optimistic.
So there's a pattern of error in sovereign debt projection. What is the finding exactly?
The data reveals a significant positive forecast error. What that means is the realized debt to GDP ratios, what a country's debt actually turns out to be 5 years from now, are consistently and systematically larger than what was forecasted today.
It's not a random error. It's a structural optimism that's just built into the system.
That's right. And it's often driven by political incentives. No government body wants to project a deteriorating debt situation.
It undermines public confidence. It limits your future spending plans.
Exactly. So forecasters often rely on these highly optimistic baseline assumptions for economic growth. They assume a smooth, continuous recovery, and they tend to underestimate the fiscal cost of future shocks.
Let's talk about the scale of this error. If it increases over time, how inaccurate is a typical 5-year projection for a country like the U.S.?
The magnitude is startling. At the 5-year horizon, the mean forecast error for major advanced economies reaches approximately 10% of GDP.
Wait, 10% of GDP. Let's put that in context. If the official forecast today says the U.S. debt to GDP ratio will be 120% in 2029.
History suggests the actual realized ratio will be closer to 130%.
A 10% discrepancy is enormous when you're talking about multi-trillion-dollar economies and debt levels that are already structurally concerning.
And this isn't just because of over-optimistic growth forecasts. For advanced economies, a huge part of this error is associated with surprise recessions.
The forecasters just miss the timing or the severity of the downturns.
Right. And when a recession hits unexpectedly, two things happen at once. First, GDP shrinks. That's the denominator, which automatically pushes the ratio up.
And second, the government deploys massive fiscal stimulus, that's the numerator, which increases the actual debt.
Both forces work together to accelerate the debt ratio far beyond what was ever officially projected.
It almost sounds like the forecasts are designed to be wrong because they assume this steady state that is always disrupted by the boom-bust cycle, or maybe by what some people call the Kondratev wave.
The long-term, 50 to 60-year economic cycle that suggests we might be in a winter period of deleveraging and crisis right now.
Right. Whether you subscribe to that specific theory or not.
The pattern recognition is clear. The underlying vulnerability, the sovereign's fiscal capacity to act as a backstop, is structurally weaker than the official numbers would have you believe.
And that weakness is exposed at the exact moment the crisis hits. And you need that backstop the most.
Which brings us to today. We've just lived through the largest fiscal intervention in modern history with the COVID crisis. If we apply this historical pattern of forecast error to our current situation, what does that mean for the debt path leading into that 2026-2027 crisis window?
The global financial crisis is the perfect parallel here, isn't it?
It's a perfect analog. After the GFC in 2009, the IMF projected that debt ratios would peak and then gently decline.
But in reality,
the realized debt ratios just kept on rising, leading to these massive forecast errors years down the line. The sovereign's ability to handle the next shock was being undermined by a continuous debt increase that no one was officially predicting.
So if we look at the IMF's 2021 projections for public debt, which suggested, again, stabilization or even a slight decline by 2026, we have to assume those are built on the same structural optimism.
You absolutely have to. If we apply that GFC-level forecast error to these post-COVID projections, you get what we can call a corrected debt path.
And instead of stabilizing or declining, this corrected path shows the debt ratio just continuing to rise or stabilizing at a much higher level than advertised.
Which means that by 2026 or 2027, the U.S. government's implicit capacity to provide that necessary liquidity put, that bailout, it's going to be significantly impaired.
The fuel tank is already closer to empty than we think.
The whole system has grown accustomed to infinite government backstopping. The entire shadow banking ecosystem relies on this implicit promise. But if the government is fiscally far weaker than anyone anticipates when that next institutional run begins,
The shock will be amplified, and the policy response might be constrained.
leading to a much deeper collapse than policymakers are prepared for.
Okay, we've established this confluence of risks. We have hyper-concentration and extreme valuations. We have massive leverage hidden in the shadow banking system. And we have a sovereign backstop that is much weaker than advertised. What does this potent cocktail actually mean for the financial outcome during a 2026-2027 shock?
It sets the stage for what our sources call the colossal transfer of wealth.
How does that work?
The sequence of collapse often follows 5 stages. It begins with an initial shock, maybe that CRE crisis, followed by a brief false recovery, a bear market rally.
And then the inevitable phase of chain reaction collapse, fueled by margin calls and forced liquidation.
If the cash PMs panic and run on the dealers, and the dealers turn around and run on the risk PMs, forced liquidation is the only possible outcome.
And liquidation means selling huge quantities of assets, bonds, stocks, derivatives into a market that has no buyers.
So prices plummet. And who holds those assets? Well, the leveraged risk PMs, whose funds are ultimately connected to the pension funds, the mutual funds, and the 401k accounts of the middle class.
The same 2/3 of households we mentioned earlier.
Exactly. So the middle class loses a substantial portion of its paper wealth through the market decline and the effective annihilation of these leveraged portfolios they're invested in.
And meanwhile, the safe money,
The elite investors and the sophisticated cash PMs who refused leverage, who held actual safe assets like cash, T-bills, or gold, they just wait on the sidelines. They've avoided the margin calls.
and when the leveraged portfolios are liquidated, forcing asset prices down to historic lows.
The safe money steps in and acquires those same assets for pennies on the dollar, completing the transfer. The leveraged capital is wiped out. The safe capital captures the distressed assets.
So the crisis, while it's triggered by institutions, results in this massive structural shift of capital from the middle class to the financial elite.
That's the mechanism.
This has been an incredibly detailed journey. Let's try to synthesize the key takeaways for the listener.
First, the current market environment is genuinely risky. It's driven by hyper-concentration and huge institutional leverage.
And while the fear of a 1929-style collapse is high, the market today has vastly more household participation.
Which paradoxically forces policymakers to intervene sooner than they did 90 years ago.
Second, the regulatory scaffolding is much stronger for traditional banks, the visible part of the system.
But the real unseen vulnerability is in the shadow banking system, that non-bank world where dealers match safety-seeking institutions with highly leveraged asset managers.
And that system is prone to devastating institutional runs and margin calls that can trigger a rapid collapse.
Third, and this is so critical, official debt forecasts systematically underestimate future sovereign weakness, often by 10% of GDP over 5 years.
This suggests the government's capacity to act as the ultimate backstop, the public put, will be significantly weaker than advertised when the structural vulnerabilities of 2026-2027 really peak.
The sheer size of the debt might constrain policy, leading to a deeper crisis than anyone anticipates.
Okay, so we've established that the system is fundamentally prone to these institutional runs, just like we saw in the GFC. Now, if the policy response to the next big systemic shock involves giving the shadow banks direct, explicit access to public liquidity,
Essentially making the Federal Reserve the dealer of last resort, a measure that's been widely discussed since 2008.
this would simplify the system. It would stop the panic in the short term.
But it begs a crucial question for you, the listener, to really think about on your own. When the government explicitly guarantees the leveraged private activities of hedge funds and asset managers, activities designed to extract maximum yield for their very wealthy clients, how does that change the fundamental nature of capitalism and risk? If the profits are all privatized through leverage, but the losses are socialized and secured by the public's full faith and credit, what responsibility does the private financial sector truly bear for the risks it creates? And more importantly, how do you protect yourself when the only backstop relies on a debt path that is itself fundamentally unsustainable?